Welcome to TalkTickers. We're your direct line to understanding what really matters in the latest earnings calls.
That's right, cutting through the noise.
Today, we're taking a deep dive into Regions Financial Corporation's second quarter 2025 earnings call.
Ticker RF.
Exactly. Our mission, as always, is to quickly hit the headlines, but then really unpack the strategy, the financial drivers, the forward look straight from management.
Giving you, our experienced investors, that essential context you need. It's not just the what, it's the why and the what's next.
Okay, let's get into those headline numbers then. Regions reported strong Q2 earnings, $534 million or 59 cents per share.
And the adjusted figures were just slightly higher, $538 million, 60 cents a share.
Right, but the number that really jumped out showing that core operational strength.
Yeah, you're probably talking about the pre-provision income, $832 million.
Which is up 14% year over year. That's significant.
It really is. It shows you the earnings power before you factor in credit provisions. And backing that up, a very robust return on tangible common equity, 19%.
19%, okay. Management sounded, well, pretty proud of that. Attributed it to executing their plans, making investments. Seems like things are clicking.
Definitely. You can see the strategic focus starting to pay off, especially when you dig into the details, starting with their funding.
So let's dig into that foundation, their deposit strength. Average deposits kept growing this quarter.
They did, across consumer checking, small business, wealth management.
And I saw consumer deposits grew in all 8 of their priority markets. That feels like broad-based success, not just isolated pockets.
Absolutely. And zooming out, they mentioned over 30% organic growth in total average deposits over 5 years. It's, among the best in their peer group.
So those targeted strategies are working.
Seems like it. Deposits in priority markets grew 20% more than core markets. And they highlighted a recent money market campaign, 85% new money in those priority areas. That's focus.
Wow. Okay, but growth is one thing. What about cost? Interest-bearing deposit cost actually declined. How did they manage that?
Yeah, down to 1.39%. It shows really effective management, even with higher costs to acquire new money at the margin.
So they're controlling the overall blend well.
Exactly. They hit a 35% cumulative beta on the down cycle. Basically, they lowered rates paid to depositors effectively as market rates fell. That directly helps their margin.
And the deposit base itself sounds sticky.
Very much so. Over 4.5 million consumer checking accounts, average balance $5,500. Then 400,000 small business customers, averaging $15,000. It's granular, loyal, low cost.
Makes sense. And the outlook for the full year on deposits.
Now expected to be up modestly versus last year, so continued stability and slight growth.
Okay, solid funding picture. Let's flip to the asset side. Loans. Average loans were stable, but ending loans grew.
That's right. Ending loans were up 1%, with growth in both consumer and corporate.
What drove the business side?
Mostly C&I, commercial and industrial. Think structured products, manufacturing. Also some real estate, mainly multifamily projects approved earlier that are now funding up.
And sentiment seems better.
Yeah, management said corporate client sentiment has definitely improved since April. They added over 300 new commercial relationships just this year so far.
That's good momentum.
And pipelines reflect that. Wholesale pipelines up 17% year over year, 30% over Q1. Production's also up strongly, about half of it funded.
Okay, and consumers. Still healthy.
Looking good. Modest increases in debit and credit spend. Credit quality is strong. Payment rates on cards are actually above pre-pandemic levels.
That's a positive sign. So full year loan outlook.
Stable to up modestly versus 2024. So similar to deposits, controlled growth.
Now they talked about remixing the portfolio, exiting almost $1 billion in leveraged lending, mostly tech.
Right. That was a deliberate move over the last 12 months. It's all about ensuring they get paid appropriately for the risk they're taking, not just chasing growth.
Disciplined approach.
Exactly. And they're targeting another $400 to $500 million in commercial runoff for the rest of the year. Very little on the consumer side, though.
Got it. Strategic pruning. Let's move to net interest income NII. Big rebound sequentially, up 5%.
Yeah, helped by some Q1 negatives not repeating, plus some positive one-offs. But also, deposit pricing performance and the benefit from fixed-rate assets turning over were better than they expected.
How much better?
Well, they added about $3 billion in new fixed-rate loans and securities at yields roughly 140 basis points above what was maturing. That's a nice tailwind.
And they added some MBS?
Yeah, $1 billion in agency MBS back in April.
Yeah.
Said it was to store liquidity, manage rate risk, and optimize returns.
So NII outlook, Q3 stable to modestly higher.
That's the guide. And for the full year 2025, they now expect NII to grow between 3% and 5%, a nice upward revision.
Okay. And the all-important net interest margin, NIM.
Expected to stay in the low to mid 360s for the rest of 25. But they see an upward path into 2026, assuming market rates follow the forward curve.
Any chance of hitting that 4% mark they sometimes talk about?
It depends. They laid out the factors. Normalized yield curve, maybe 10-year at 4%, short end at 3%, continued growth in non-interest-bearing deposits, cutting deposit costs quickly, and a good mix from their fixed-rate book. It's achievable, but needs things to align.
Right. Several levers need to pull in the right direction. Okay, moving on from NII, fee income. Looked pretty diverse.
Yeah, adjusted non-interest income up 5% sequentially, growth in mortgage, the usual seasonal bump in card and ATM fees, and a record quarter for wealth management.
Wealth management keeps performing well for them, doesn't it?
It really does. Record fees growing at an 8% compound rate since 2018. They even got recognized for their trust and planning services.
What else stood out on fees?
Treasury management is strong, up 8% year to date, more clients served. They see more potential there, especially with small businesses. And capital markets, excluding CVA, was up 5% from Q1, driven by M&A advisory, real estate capital markets. They expect that to edge up a bit more in Q3, maybe $85–95 million range.
So the overall fee outlook for the year.
Adjusted non-interest income now expected to grow 2.5% to 3.5% versus 2024. Solid contribution.
Okay, revenue's looking good. What about the other side? Expenses. Adjusted non-interest expense was up 4% sequentially.
Yeah, mostly salaries and benefits. Things like an extra workday, the full impact of merit raises kicking in, revenue-based incentives. Headcount also grew slightly, over 100 associates.
But the full year outlook is more contained.
Much more. Expected up only 1% to 2% for the full year 2025. And importantly, they're committed to generating positive operating leverage.
Meaning revenue grows faster than expenses.
Right. They're targeting 250 basis points of that this year and committed to it over the long term.
How are they balancing that with investments, especially in tech?
That's the key. They're investing heavily, rolling out a new native mobile app now, upgrading their commercial loan system to the cloud soon. And the big one.
The core deposit system.
Exactly. Piloting a new cloud-based system late 2026, full conversion planned by 2027. They want to be one of the first regionals on a truly modern core platform.
That's a huge undertaking. Big potential upside in efficiency and product delivery down the road, but requires investment now.
Definitely a long-term strategic play. And they mentioned banker hiring is on track too, getting those relationship managers in place.
Okay, let's touch on asset quality and capital. Always crucial for banks. Look like improvements across the board?
Pretty much, yeah. Provision was only $13 million over net charge-offs. Allowance ratio down slightly. Net charge-offs themselves decreased to 47 basis points annualized.
NPLs improved too.
Non-performing loans down to 80 basis points. Criticized loans, delinquencies, all improved.
But they still expect full-year charge-offs towards the higher end of their range.
Yes, towards the top end of 40–50 basis points. They flagged this is mainly due to those known areas, transportation and office CRE. But they expect Q3 losses similar to Q2, then declining in Q4, and they believe losses are already reserved for.
Okay, it sounds manageable. Capital levels, CET1.
Ending Q2 at an estimated 10.7% CET1. And CET1, including AOCI, which reflects unrealized losses on securities, actually improved slightly to 9.2%.
And they're managing that AOCI inclusive number near the bottom of their target range.
Yeah, closer to the 9.25% lower end. Gives them flexibility for potential regulatory changes or strategic moves.
And capital return, buybacks, dividends.
They bought back $144 million in stock, paid out $224 million in dividends in Q2. And they announced another dividend increase, 6%. That makes it a 10% plus compound annual growth rate on the dividend over 6 years, which they pointed out is the highest among their peers.
Strong track record there.
And on buybacks too. They've repurchased more stock relatively than peers over the last 10 years, all contributing, they argue, to top quartile total shareholder returns over 3, 5, and 10 years.
Okay, that's a comprehensive look at the quarter.
Yeah.
Now let's put it in context. What's management seeing in the broader economy?
Generally positive, it seems. Corporate client sentiment improving since April. They mentioned the tax package providing certainty, especially bonus depreciation helping equipment and construction.
And consumers?
Still in very good shape, good liquidity, managing debt, maybe pulling back slightly on luxury spending, but fundamentally solid. They also noted clarity on tariffs helps business confidence. Overall, seeing positive momentum for the rest of 25 and into 26.
Okay, a constructive backdrop. What about competition? They operate in some hot markets.
Oh, definitely intense. Banks, non-banks.
Yeah.
They acknowledge it, but they lean on their long history, 170 plus years, in some places, strong brand, and just focus on execution, building relationships.
Seems to be working with that 5% annualized relationship growth in commercial.
Right. And they stress their focus on risk-adjusted returns, not just growth for growth's sake. They feel that's why their loan yields haven't been squeezed as much by competition as some others.
Makes sense. Discipline pays off. What about M&A? Any appetite for bank deals?
Very clear answer on that. No,
Yeah.
not interested in depository M&A right now.
Why not?
They see it as too disruptive, especially with that massive core technology project underway. The focus is 100% on executing their current plan, getting the tech upgrade done, delivering top quartile results organically.
So internal focus is key.
Absolutely. They left the door open for non-bank deals, but said nothing interesting has come across their desk lately.
Okay, that's very clear strategic messaging. Given all that, Region's solid quarter, their specific strategy, let's move to our not financial advice segment. Time for an outrageous yet plausible trade idea.
All right, let's hear it. What have you got?
I'm calling this one the patience on platform, profit on penetration pair trade.
Okay. Intriguing name. Lay it out.
The idea is go long Region's financial wealth. Let's use ticker XYZ as an example and simultaneously short a regional bank peer ticker ABC, perhaps.
And the peer profile, what are we shorting against?
You'd look for a peer with maybe a higher concentration of non-operating, more rate-sensitive deposits, and critically, one without such a clearly defined, ambitious, long-term core tech modernization plan like Regions has.
Okay, so what's the underlying thesis? Why this pairing?
Right. The thesis is multifaceted. One, Regions is actively de-risking loans while aggressively growing sticky, low-cost core deposits, especially in those priority markets. That's a funding advantage. Two, that massive investment in a modern core platform by 2027 using AI. It's a huge multi-year strategic bet on future efficiency and better product delivery. A lot of peers just aren't doing that at this scale.
It's a bet on long-term structural advantage.
Exactly. Right now, the investment hits expenses and loan growth is guided as stable to modest, but the long-term potential for superior operating leverage, better margins, maybe hitting that 4% IM in the right environment is significant.
So the outrageous part is betting on the payoff from a slow-burn tech transformation.
Precisely. And betting that their sticky deposit base gives them a sustained funding edge over a peer whose funding might be more volatile, more expensive, and whose operations might become less efficient comparatively over the next few years. It's not about chasing near-term loan growth. It's a bet on a structurally superior model emerging over time. Patience on the platform, profit from penetrating those markets with better tech and funding.
That's a well-reasoned long-term view, definitely plausible, even if it requires that patience you mentioned. A good thought provoker.
So wrapping up, Regions delivered a strong Q2. Disciplined deposit growth, strategic loan remixing, and a clear path, they believe, for NII and NIM to improve into 2026.
Yeah, and those big tech investments alongside a commitment to positive operating leverage really signal a long-term focus on efficiency and shareholder value. They're being selective about growth, but building for the future.
As always, everything we've discussed today is purely for informational purposes. It's not financial advice. Markets move, investing has risks.
Absolutely. We encourage you to think about how these insights fit your own strategy and what Region's unique path might mean for the wider regional banking sector.
Thank you for tuning into TalkTickers. We appreciate your time and look forward to our next deep dive.